You're watching HFO TV, your partner in Pacific Northwest multifamily investing. HFO TV is brought to you by Pacific Exteriors Northwest, apartment siding contractors with nearly 30 years of experience, providing exceptional quality and service to multifamily and residential owners. And by Gantry Incorporated, the nation's largest independent mortgage banking firm.
Welcome back to HFO TV. I'm Greg Frick, partner at HFO Investment Real Estate. Today, we're lucky to have back with us John Gillem, Director of Market Analytics for CoStar, probably the largest real estate analytic company, I would think, probably in the world now. And then we're not going to talk about homes.com or the one we see all the ads for. So,
right, yeah, no, that's a good point, Greg. Certainly continuing to grow, pushing further into Europe, and obviously a very, very strong presence in North America, as you said.
Well, we always like to have you on because you can give some good insight in terms of what you're seeing in the numbers for the Oregon, Washington multifamily side, and maybe comparing it to some other markets. So again, thanks for taking the time to jump on a quick Zoom call and do this. So what we're hearing anecdotally, and I'm seeing it in some of the stuff that we're underwriting, that the Portland market is getting better in multifamily from an operational occupancy. What are the numbers showing you?
Yeah, it's a great point, Greg. I'll try not to ramble too much. I'll start with kind of my high level overview. I think the script has certainly been flipped. We were in a period of rising vacancies, a supply glut, late 2022 through 2023. And that has now changed. Starting back in 2020 as COVID took hold, people relocating were having a big impact on Portland from a leasing standpoint. It was still an affordable gateway. A lot of construction projects got paused, vacancies declined, and rents ballooned. That quickly reversed course. By late 2021, we started to see a bit of an erosion in population. People were fleeing the city for several reasons, crime being one of them, affordability reasons as well. And as a lot of those projects that were paused during the pandemic started to make their way back into the pipeline, and groundbreaking started to tick back up, we saw vacancies start to rise as leasing couldn't keep up. But now, like I had alluded to earlier, we've seen that script flipped, and a couple numbers just to kind of put that in perspective. On a trailing 12-month basis, we've absorbed through leasing. So absorption is move-ins minus move-outs on net. We've absorbed about 5,700 units over the last year. Which is a massive increase from that low mark that we witnessed in mid-2023 of about 1,700 units.
So mid-2023, we're at 1,700 trailing 12 absorption. If we go now trailing 12, we're at 5,700 units. Okay.
So a big, a big spike there. And we're not back to that high water mark we saw in 2021, when actually in mid 2021 in the second quarter we had over 4,000 units absorbed in that quarter alone, and I think that year we absorbed nearly 10,000 units. So we're not back to that high water mark yet, but we do think that demand erosion that we were seeing has plateaued, and we think it's reached a bottom, and will continue to gradually inch up over the coming quarters.
Now, do you see that, like let's take Seattle? Do you see that same trend in Seattle?
We do. We're seeing that same trend in Seattle, and as we'll get to construction here in a bit. But Seattle has always benefited very strongly from international in-migration. Obviously, It's a big market. It's exploded in terms of biotech over the last decade, and it's become a staple tech market as well. A lot of growth in Bellevue there on the east side. So their population dynamics have returned to normal, right? They've returned to positive growth on a year-over-year basis in terms of when we measure that year-over-year change by percentage. And so they are consequently seeing leasing stabilize and start to move in an upward direction. And despite the fact that they are delivering much more units than Portland is relative to market inventory, relative to size, right? They are able to absorb those units, and our vacancy rates actually are pretty identical right now, just under 7% for both markets. Even though Seattle has delivered a lot more units over the past year. So
the numbers show for like the Portland market, the kind of the out migration that we talked about before, that has slowed down. We didn't have the sheer large. I mean, we had a large number of deliveries, but it wasn't. And when you take in relation to other markets as a percentage, it still wasn't that great. So do you envision that we'll see continued occupancy rates increasing and vacancies coming down as this absorption period continues and we have less on the development side?
I think you're spot on, Greg. We are fairly confident that vacancies have peaked and will continue to edge down over the midterm. And to put some of those numbers in perspective, and some of the driving factors behind why we believe this to be the case, I have some. We're looking at some of the top markets in the country here. The top 10 markets in the country in terms of supply growth, inventory growth. Think Sunbelt, Eastern Seaboard, and those top 10 countries over the last 12 months, on average, delivered just under 22,000 units, on average over the past 12 months. In Portland, we delivered 6,100 units. So we're, less than a third of supply hit our market when compared to the top 10 markets. Now, digging a little bit deeper, when we measure that on deliveries or under construction as a percentage of inventory, which is going to show the magnitude of that expected change, those top markets right now are averaging about 6.2%, meaning what is underway right now will change their market inventory by 6.2%. And in Portland, our figure is 2.7%.
Wow.
So that supply magnitude in Portland is going to have a much less pronounced effect on our inventory. And when you blend that with recovering demand, that's a pretty good tailwind for vacancies to decline, rents subsequently to come back. And as concessions start to melt away after following those dynamics, strengthening net operating income and hopefully generating some more investment activity and interest in the market as well. So it's good to compare Portland to some of these other areas. And while some of those markets might not be truly peer markets, it's just good to kind of give a reference point of where we stand.
Well, I think because there's a perception that we've got all these, last couple of years that we've had all these units delivered, and yes, we've had a lot, but when you look at the percentage of your total market, we're still way behind a lot of other markets in terms of deliveries of newer units. So as we get a change in immigration and population and job growth starts coming back, we've got a lot less units to have to absorb. So which is where we were years ago, when we were, the affordable market on the West Coast, and because of variety of reasons, bureaucratic, government, just land use and things like that, we just have a really hard time, getting new units in place at any kind of magnitude.
I agree 100%. Our numbers show the same thing. We're setting up for we're set up for a similar recipe to that time frame that you referenced. So yeah, like I said, 6,100 units delivered over the past 12 months, about 6,100 units underway right now. Just a little comparison to Seattle, they've delivered about 13,000 units over the last year. They have over 20,000 units underway right now.
Wow.
However, as I said, they are equipped to continue absorbing that supply again. like single family homes there are kind of prohibitively expensive. And as long as there's not a cataclysmic economic meltdown, we do believe that both markets are fairly well positioned to absorb the supply that's going to hit over the next year or two.
And locally, are there certain submarkets that you guys are looking at that are, have more, I guess, more tailwind or more, looking forward? What do you see there? Is there, coming in out of the pandemic, there was a big push to, tertiary markets. What do you see? What do the numbers show?
Certainly, Greg, it's a very good question. Right now, for the markets that are probably going to have a longer runway to equilibrium, and subsequently rent growth starting to work its way back into the green. Though think the central city area, so CBD, and then the inner urban areas like Northwest, Southeast Portland, and Southwest Portland. Those are the areas right now that are getting hit with a ton of supply.
Right.
Northwest especially. And while occupancies have strengthened in the urban areas and downtown, since the exodus that happened in 2021, the leasing activity hasn't quite picked up enough to bring those vacancies down meaningfully near term. But hopefully, as some of these negative external factors that we've experienced, such as crime, hopefully we've seen a peak in crime, and when we start to have more residents feeling comfortable living downtown, hopefully we'll see some of that leasing rebound. And as those deliveries hit the market, those are able to their management there is able to absorb those units. However, expect concessions to remain quite high as well to get people in the door. Another area that's delivering a lot of units, but is absorbing those units, obviously Vancouver. It's the population growth darling of the region right now. We expect that to continue. Tax advantages, the ability to duck across the border into Oregon to shop. And Vancouver's dramatically different than it was 20 years ago. It's vibrant. There's a lot going on the waterfront. We expect people to continue to want to live there. Other areas to keep in mind, Hillsborough was a real rent growth underperformer the past 12 to 18 months. They dealt with a ton of new supply, particularly in that Amber Glen area. They have now come back. Watch out for Hillsborough. Looking at growth at Intel and construction jobs there as they start their new semiconductor facility expansion. Rent growth there has really turned a corner, and as they've sort of gotten through their supply glut there and leasing has stabilized, vacancies have really come back down. We expect rents to pop there again over the next 12 to 18 months. Also think in terms of real outperformers where vacancies are really going to get crunched and landlords are going to be able to boost rents heavily. Think those fringe exurban markets, Yamhill County, rural Clark County, rural parts of Oregon City, where tenants are moving for affordability reasons, and even parts of rural Washington County as well, where residents want maybe a little bit slower pace, more affordable rents, and not a lot of supply. These areas often are off the radar, certainly of the institutional builders. So as more and more people kind of migrate out, and those areas don't really have an influx of new units coming in, we do expect vacancies to remain low in those tertiary exurban areas, and for rents to outperform pretty substantially there.
And again, we talk about supply. I mean, it's all relative. Yes, it's heavy for here, but when looking at other markets, as a percentage of your total supply, we just are not delivering that many units. People that aren't in the know, there's just this assumption that, we just have this oversupply. Like, it's a kind of a blip a little bit to say, but once this, bubble kind of gets through, we don't have a backlog of more units. And even when we go, super aggressive in terms of supply, when you look at other markets, our percentage of units delivered is always, down.
You're absolutely correct, Greg. And Portland cannot as a region, we're never going to be able to deliver the number of units that the Sunbelt markets are going to deliver.
Right.
It's the same goes for Seattle. We're very protective of our green spaces here. We have wetlands protections. We just don't have a lot of land marked for massive 3, 4, 5 phase,
Right.
4, 6, 800 unit projects. We just don't get those out of the ground as quickly as some of those other markets that can expand. Even Boise, has a ton of land, and we've seen Boise expand rapidly on its west side. That's just not the case in Portland and Seattle. It's a much steeper planning and approval process. And so these 6,000 units that we have underway right now, while that might seem like a lot, I think it's important to remember that those are going to deliver over time.
Right.
And to your point, as a percentage of inventory and as factoring in how much it's going to grow our inventory relative to where demand is and where we think demand will be, it's not a drop in the bucket, but it's not going to have a dramatic impact.
Our governor came out and said the goal was 36,000 housing units. And I remember looking like, have you looked at the numbers? Are we annexing in some, you're going to just start developing in Eastern Oregon? we're just not equipped to come that in the Willamette Valley.
Right. It would certainly take in a very extended period, to your point, Greg, a lot of new land annexed. And it's going to hit that number, not saying that it's unachievable, but we would have to dramatically alter our process, particularly at the policy level. And, when in the Sun Belt, they can get, units approved, in well under a year, in some areas, maybe even 6 months, a high rise here is going to take well over a year to go through planning and approval. So again, not saying it's unachievable, but that's a very big number for sure.
And it's a big shift. And I know you guys do, again, we're in the multifamily space, but what are you seeing in terms of like single family home pricing? Some of the markets you cover and how that reflects or what that, how that affects rent growth.
I think there's always concern that more apartment units coming online, what effect is that going to have on home prices? Is it gonna bring home prices down? We don't think there's any data to support that claim. I think the last MLS reading I saw showed that Portland home prices were relatively flat year over year, maybe about a 1% increase. So what's happening at the single family level, Greg, is that it's a supply issue. So home prices are flat to slightly increasing, even though there's not a lot of buyers out there right now, or not as many as there were in 2021, 2022. We don't have enough supply coming online. So I've talked to a lot of people that, are saying, well, interest rates are 7%. Why aren't prices coming down to match that purchasing power that, a borrower is someone who's borrowing to get into the housing market is going to have. And it's because, sellers are content sitting on their homes. You go to homes.com, you see a lot of stuff that's been listed, 30, 60, 90 days, which is probably more reflective of a traditional housing market. I'm sure you've bought in times when, you put your house on the market, it takes 2 to 3 months to sell it. What we were seeing in 2021, where people would put a house on the market, they would have 8 offers in the first weekend. That is not normal. That's not historically how it has been. So right now, if I'm a seller in the West Hills, they're not lowering their price because I think they know eventually someone's going to come from the Bay and pay them what they want, and they're willing to sit for a month or two. So prices just have not come down, and it's because markets are imperfect, but they are intelligent, and they know that the amount of competing supply coming online is not going to have a dramatic impact on that face value or desirability of their property. And a lot of sellers know that eventually that the right buyer is going to come along that's financially equipped and purchase their house. So we haven't seen single family home prices come down, and we don't expect them to come down substantially. Again, barring a cataclysmic economic event, we don't expect home prices here to drop substantially anytime soon, and it's a supply issue.
Well, and I think we talked last year about this, that when you've got 60% of the homes that have mortgages are under, I think it's either 5%. They're not going to give up that mortgage to trade unless it's a bigger, it's not just, hey, let's go get a new house and we lose my 4% interest rate to go get a 7. So you're going to have less units on for sale. So, there'll be less opportunity to buy, which is going to hold the pricing. And again, then reflects back to multifamily. I think you've got people that maybe in the last 10 years would have traditionally, hey, let's go buy that house. They're now, it's going to stay in multifamily again, which will help with a little bit of the absorption and help, stabilize rates.
Yeah, it's a great point, Greg. It's a great point. That low inventory is also underpinned, like you said, by people that don't want to trade out of a 2 to 3% interest rate. And report today came out on national building statistics. Home starts nationally were down. So even at a top level, when you have starts down and less sellers willing to trade out, to your point, it's a recipe for constricted supply, certainly. And we do think, again, it's never a 1-to-1 correlation statistically. But prohibitively high single family home prices naturally are going to lead to some tailwind into multifamily leasing, to your point, as
Definitely.
people that would have bought, those that are on the fence. I ran the numbers. Let's take a $500,000 house in Portland, right? Because anything under $400,000 is going to need some work. If you want a nice $500,000 home in a decent neighborhood that doesn't require a lot of work, that's if you have the $100,000 to put down. It's a $400,000 loan at 7%. Your P&I alone is going to be over $2,600. That doesn't even factor in taxes. Our market or our modeled rent right now across Portland is about $1,700 per unit on average. So that spread is just it's right now for a large portion of the population, it is cheaper to rent.
And I don't see that demographic. I don't see those numbers changing in the short term. I mean, we'd have to have just a massive amounts of rent growth, or you'd have to have our interest rate drop significantly. But once that happens in the single family market, then you'll probably see pricing go up again. And so I think it bodes well for multifamily long term. I was going to ask you one other thing. It's kind of on the capital market side, because I know you guys look at that as well. I mean, what are you seeing? Are you seeing buyers willing to jump back in, or what's kind of the numbers?
High level. For those that are starting to come back, I think a lot of fund level equity is still shaky on Portland. We haven't been traditionally a market that has been able to grow our population naturally, meaning
Right.
births exceeding deaths. So I think they really want to see positive population growth return, and we could see that next year in the reading, Greg. Our population loss in 2022 versus 2023 was it was a factor of 10. So we lost about 0.3% in 2022. 2023 was about 0.03% loss for Portland.
Okay.
So we are eagerly awaiting next year's number to see if we dip back into positive.
But trending in the right direction. We're trending in the right direction for that. Yeah.
I like to say we're bleeding, but we're bleeding much less. And I think for a lot of that fund level equity institutional, they're going to want to see population growth back on track first and foremost. And for those who are seriously looking under the hood right now, I think there's a certain number of those investors that are probably willing to go negative leverage, but there needs to be a very strong rent growth story,
Right.
Over the coming quarters and out 18 months. Some of those suburban areas we talked about, that story is there. So some of these buyers may be willing to go negative leverage for a little bit and take that jump. What I will say in terms of movement, just some numbers to keep in mind. And capital markets activity over the past about 6 quarters, way down, obviously. So we're looking at about over the past year, volume has slowed to about 930 million. For reference, our 10-year average was around 2.3 billion. Given that peak in 2022 of about 4.6 billion. So we're still kind of that's pulled the average high, but 928 million, that's low when you look back 10 years. But on a quarterly basis, we've really stabilized in that 200 to 350, 400 million range over the last 6 quarters. So we haven't dropped below that mark. It's been pretty steady in that area, which is a positive sign that there is activity. There are buyers out there looking. And then we're of course keeping a close eye on rate cuts, how the Fed feels about its fight to control price growth. And if 2 to 3 rate cuts come into play, does that make Portland more attractive? I think it does. We've always been a market with a lower basis and a higher yield. So I think there's going to be some opportunities out there for investors if certain macroeconomic events end up falling into place.
Well, I think you hit the nail on the head. But in terms of, I think a lot nationally for a lot of groups need to see that positive immigration, because I think we've got the story on the fundamental side of where we're looking at this lack of supply coming online. You get some kind of positive immigration, you can make the story of the rent growth, so you can absorb maybe negative leverage in the short term with the positive outcome in the future. We just need to see a couple numbers kind of click around, and if you get a drop in interest rates, it only makes it that much easier. So.
Absolutely. I think there's a strong case in place for NOI growth over the next year. I think that's pretty clear. And then if the market can show that population that erosion has stabilized and is starting to recover, I think that's a good recipe for the market.
Well, thank you, John, for taking the time. It's always insightful to kind of get your take and seeing what the numbers show in terms of the market, and I'm sure we'll be doing this again. So thanks again for joining us on HFO TV.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.